In this segment, we're going to talk about how it all came crashing down. But first, let's talk about rose-colored glasses. We all want to believe that when things are going good, they're going to continue to go good and they're only going to get better. And our history has shown us recently that that's what's going to happen. So, we agreed to deregulation. It was one of the platforms that the current administration ran on. This increased home ownership. This is great for everyone. People who formerly couldn't own a home now got a piece of the American pie. It made more money available for consumer goods, for people who were refinancing, taking equity out of their homes and spending it on vacations and lavish lifestyles and a variety of different things, paying off debts, sending their kids to school, so many things, good things, bad things, but it did make money available for more consumer goods. It allowed people to pay off all debt, their old debts, but at the same time, instead of paying off our debts and not creating more, with the rose-colored glasses, we paid off the debts and then we created more for ourselves. Paid off those credit cards and then racked them right back up. This allowed people to sometimes get lower rates, but deregulation also affected the credit card industry so that you could get a lower rate, but when you missed a payment, there were higher penalties that were allowed and stiffer punishments, if you will, for not towing the line. This allowed people in some cases to borrow more money than their home was worth, counting on home values continuing to rise. The lenders figured if you were going to default on your loan, they were going to be able to sell your property pretty quickly, turn it over, make their money, and lend on it again, like I said before. Some of these subprime loans allowed interest-only payments on some mortgages, which increased the total amount that the borrower owed substantially over time. And if anything went wrong and they had to sell, they were going to owe more money on that house than it was worth. And most of us don't have a whole lot of savings, which is what spawned the subprime market to begin with. Back in the old days, people had savings accounts. They put down 20% on their homes. Now, our retirement is tied up in our homes. Our investment, our biggest investment is our homes. We do not, as a culture, save money and put it away for a rainy day. However, the deregulation increased businesses for banks, lenders, brokers, investors, and every other business that was attached to the industry. This included real estate agents, appraisers, attorneys, home inspectors, financial advisors. All in all, it looked great. It looked like a win-win situation, and people began to buy more. Mortgage-backed securities made huge profits, and other industries wanted a piece of that pie. Insurance industries, people's retirement funds, all tied to these mortgage-backed securities, which were riskier and riskier investments. This all led to huge increased profits for the top 1% of our population, and it spawned an environment for greed. And in my next section, I'm going to go back to who the players are and how they were affected by this greed. In this segment, I'm going to talk about how greed, combined with the rose-colored glasses we were wearing during deregulation, led to the current situation. Let's start with the players. The first player, the borrowers. Buying houses we couldn't afford. Real estate investing and flipping property. That means when you buy a property, do minor repairs, little bit of work, flip it to sell it for more money than you paid. There was a lot of money to be made doing that. We accepted a higher debt-to-income ratio. How much money are we paying out depending, as compared to how much money we're bringing in? We've, over the years, accepted more and more and more. Long ago, your housing payment should have equaled no more than 25% of your monthly income. Now, that's not the case. This caused us to put all of our eggs in one basket, meaning, like I said before, no savings accounts, having all of our equity tied up into our homes. We were compelled to lie about our income and savings because if we did, we could get a nicer house. we were being compelled to hedge on the growth of the economy. Well, you know, I'm going to owe more than my house is worth if I only pay interest right now, but my property value and my property taxes have increased so much over the last 10 years. If this continues, then I'll be out of the woods, no problem. And I plan on staying in my home, so why not? We also accepted higher rates and riskier loan types because if we took a slightly higher rate, you know, we were going to be able to not provide documentation, lie about our incomes, etc., etc., etc. How the brokers were taken in by greed. Because higher loan amounts and higher rates equal higher profits for the brokers, this led them to facilitate fraud against the lenders. It led them to sell borrowers rates and loan types they could not afford in the long run, because if someone does not default on their loan within the first, say, 3, 4, 6 months of having the loan officer still walks away with their profits. So if the loan officer was relatively sure you were going to be able to pay your mortgage for at least 6 months, it really didn't matter whether or not you were being screwed, because they were still going to be getting their commissions and they were going to be able to keep them. They encouraged people to buy and borrow more, bigger houses, borrow more money, take a higher loan to value. Then you can have this money for repairs, you can have this money for this, you can have this money for that. Brokers are salespeople, lest we forget. Lenders, there was greater competition in the marketplace, which led to lower standards, less quality control, and riskier products. The more business, like I said, more business that they could get and the higher fees and rates they could charge, the higher their profit was going to be. That's where greed hit the lenders. Investors on Wall Street, of course, greed's the name of the game. More profits, less oversight, riskier investments. In my next section, we're going to talk about how it all came tumbling down. So where are we now? The borrowers can't make their payments. They can't refinance. They already owe more than their house is worth. They start to miss other payments. They start overextending their credit until they can't pay it and still make the mortgage. They stop spending money on consumer goods. They end up in foreclosure and bankruptcy. As a result, Wall Street starts losing money. The housing market slows along with consumer spending. Credit card companies start losing money. People can't make their payments. Investors pull back on products so people can get less credit. Mortgage-backed securities are riskier. Corporations can't sell them and begin to lose money. Money for home loans gets harder to get. Housing market slows even more. The consumers begin to default on credit more, and the crisis grows. All the industries tied to the mortgage banking industry begin to lose money. Profits begin to decrease, and workers are laid off. Unemployment rises. Well, corporate fat cats take golden parachutes, get out, and leave investors, IRAs, etc. to weather the losses. The economic engine grinds to a halt. In conclusion, I'll talk about how we can avoid this in the future. So in this video, I tried to explain how the mortgage banking industry works, how something that seemed like a great idea was corrupted by naivety and by greed, and how this affects all of us. So now we're in a position where we have absolutely no choice but to fund a $7 billion bailout of the mortgage banking industry. The policies of the Bush administration and the idea that deregulation is the way to go is an outdated idea. Not that I'm suggesting socialism, I'm just saying that we have to be realistic about what our culture has become. And this all comes down to the fact that consumerism has become the new god, and the shopping mall its temples.